All right. Good morning, everybody. And Maria, good morning. Thank you for being on.
Good morning. Nice.
Appreciate you being here this morning. We're excited to hear what you have to share today. So, for everybody on right now, I know more people are jumping on right now. And whether Sherry, Jill, good morning. Maya, Nettie, good morning. For people on Facebook as well, good morning. Got an exciting training here today. Maria is going to be covering kind of all things multifamily, talking about multifamily investing, holding properties, how to price multifamilies correctly. She's really going to dive in. So, how to analyze this and really set your investors up to win. Maria is a real estate investor, a real estate coach. And if you remember several months ago, she did a really, really fantastic training on short sales. So, if you run into short sales, Maria has a lot of experience in short sales as well. Maria and I used to work at we're in the same office many years ago, and she was our go-to for some short sale deals as well. So, well-versed realtor. You got a lot of experience, Maria, and we're excited for you to share. And the floor is yours.
Thank you so much, Michael. And it's good to be here again. I do love doing these things. I like talking about real estate, obviously. So this is great. Before we start, I wanted to give the premise for this presentation. I have noticed that this has been going on for a long time, but it's especially glaring now because we are in a market that I'm calling quote unquote frozen, for the simple reason that I'm sure you guys can relate. Not a lot of stuff is moving, especially when it comes to investors. The investor stuff. So that's why we're focusing on multifamilies today. But this is because I was mentioning to Michael when I envisioned the idea of this presentation that what I'm seeing is that a lot of stuff that could move is not moving because it's mispriced. Now, while this can always happen, we will always have mispricing. Oftentimes is because of the sellers. They don't want to, they want what they want for their property. And then we have poor listing agents that are stuck with a property for months and months that is not moving and the seller doesn't budge. Obviously, we don't want that. And this happens quite a lot. And it's happening more and more in the multifamily market, in the rental market in general. It doesn't have to be a multifamily. It could be a single family home. But anytime we are dealing with something that is which has as highest and best use the fact that it could be a rental, then we run into the situation. And the reason is that we have residential or agents that normally focus on residential sales. All of a sudden, of course, we don't want to say no to a seller that wants us to do a listing. Then we run into the issue, though, that we try to price things the same way that we price residential property. And it doesn't quite work that way because while you might get lucky and have a person that wants to own a rental that doesn't really understand rentals, and that's fine. They might just be buying it because they have a lot of cash lying around, or they want to be in a certain area and not have to worry about it. Whatever the situation might be, there's all kinds of investors, and every strategy is totally acceptable, obviously, as long as it satisfies the investor itself. What ends up happening is that the vast majority of rental properties, especially when it comes to duplexes and more units than that, normally you need a professional investor to buy them. And what happens is that these investors use certain formulas and they look at certain things to buy something. And so if you want to move something quickly or fairly quickly, obviously, we're not trying to do fire sales, the property has to make sense. Otherwise, you will end up holding on to it for months and months and months. I literally see, because I follow them, because I buy multifamilies, I literally see properties that are dropped where the price is being dropped $100,000 every few months, and they're still not selling. And this is craziness. And the properties are good. They're just completely mispriced, where investors who normally don't have a problem submitting low offers on a listing, if that's a correct offer to be making, they won't even touch it because they're already thinking there's no chance, which is what I'm thinking. There's no chance this guy is going to give me a $200,000 discount, even though the offer I'm making makes sense. I'm not trying to lowball anybody. And I know that if I'm in the situation, I know for a fact, in fact, I work with a lot of investors, that that's the case out there. I don't want this to happen to you. If you're going to be dealing with a property, I would like you to know exactly how to price it, and then you can find a midway with the seller by you bringing factual data where they know if they're overpricing or not. It's not just an opinion of value compared to other stuff that's sold in the area. This is one major point that I want to make. rental properties are not sold based on ARV, which is basically comps, the after repair value, etc. They are sold based on income. And a lot of property I'm seeing, oh, because that's sold at this price, this will sell at about the same price, and it will not. And this is what we're seeing. So let's jump in. And I told Michael to let me know if there are any questions that come in throughout, because some of the stuff is a little bit technical. And I just want to make sure that everything is clear. So if you guys have questions, feel free to put them in the chat. I don't see them, but Michael will let me know. And I'm happy to stop at any point, because again, I don't want to just talk here and then, not make it clear when it could be clarified. All right, very good. So let me see here. Last slide forward. Very good. So in terms of the priority here, what we're trying to do. So what matters is, again, when we sell a rental property, what matters is our public, basically the investors we're trying to sell to. And obviously, while there are all kinds of investors in the market, really a buy and hold investor can look so many different ways. It goes from looking at a house hacker, somebody who doesn't want to pay his own mortgage in full or cannot afford to pay mortgage in full. So what they'll do, maybe they'll buy a duplex and they will rent out the second unit, and this will help them defray some of the mortgage cost, right? And that's what actually is becoming really popular because of where interest rates have gone, and sometimes people cannot afford to buy a single family home and pay their own mortgage. This is a great way for people to be able to buy their first property without having to pay the full mortgage themselves. Not only, but I did want to mention that FHA allows, so we're talking about first-time home buyer loans here. FHA allows investors or homeowners to consider up to 4 units to be a primary residence. So a person could actually buy a 4-plex and use a homeowner loan and put down just 3.5%. So I think that's why we're having a lot of people, more people than usual in the market, look at multifamilies as opposed to just single family homes. It's definitely an untapped market for retail buyers, which I think is very cool. So again, when we talk about buy and hold investors, there's a gamut. We go from these house hackers to somebody that buys basically properties, and basically this is their main business. And there is, all kinds of people in the middle there. Somebody might own just a few while they have a full-time job, so they're not necessarily cash flowing very well because they are, they can maintain the properties, they can maintain any expenses, maintenance, whatever, with their full-time job. These are not professional property managers, for example, so we'll run into different issues with them, all the way up to, again, people that do this and have been doing this for a long time, and they're very strict about some of the formulas we will look at. So I just wanted to give this premise because, again, there are so many, we can be looking at so many different ways of pricing these things, but in general, when we speak about multifamilies and rental units, the majority of the market of the buyers are these professional buy and hold investors. And that's why we're doing this today. All right. So as you can see here, obviously they have different criteria for the properties they will buy. But the point of this, again, is going to help us make sure that we have the greatest appeal when we list something, the greatest appeal to as many investors as possible. All right, now, in terms of objectives for investors, what are investors trying to do? So obviously, there is the cash flow issue. As Robert Kiyosaki used to say or taught us in Rich Dad, Poor Dad, is that anything that doesn't make you money is not an asset, it's a liability. A lot of people in this business as well, but also in general, believe that a house or a property is an asset. It isn't, because if you have to work to pay the mortgage and instead of the property actually putting money in your hands, then you're working for the property, so it's not an asset. And obviously we can we know there are many shades of gray when you think about these things, but just for the purposes of this presentation and how investors think about things, the asset, this is an asset, and the asset has to make money at the end of the day. That's why cash flow is really, that's why I have it underlined here, is really the most important thing that investors will look at. And we'll go more into how to calculate these things, but just for right now, other criteria that investors use to evaluate a property have to do with appreciation, of course, tax benefits. Again, you can see here risk management and exit strategies, because some people, for example, may choose to own a property forever and leave it to their kids, and some people might choose to flip these every 2-3 years and use that equity basically to move 1031 exchange to something a lot bigger. But the bottom line is that these are all things that that investors do look at. But some investors, and I do want this to be clear, some investors focus on some more than others. If I had to pick, I can tell you from experience, because these appreciation, tax benefits, risk management, exit strategies are very subjective in terms of they reflect what the situation of a certain person is, in addition to just their preference. For example, tax benefits, it depends on what the person does. If the person has a full-time job, it might be a big deal to own investment properties or rentals, because they're able to have deductions, etc., that will offset some of their earnings. Okay, but in general, again, we go back to cash flow being the primary criteria for looking at things, for evaluating if something is a good deal or not. All right, so in terms of how the investment process works for an investor. So we start by, and again, this is just giving you a highlight, but basically we start from, of course, selecting the property. There are people that will only invest in certain areas. Normally this happens if people have more cash available. Obviously they would prefer to invest in better areas. However, and I see this a lot, there are properties in better areas of St. Louis, for example, that are priced high even for those areas, because people think, oh, location is going to do it. But then you go and look at what the rents can cover, and the rents are just not there. So it's always, even if it's a great location, say a B+, A- location, or even an A location, although you don't have multifamilies in certain areas of St. Louis in A locations. But so even in that case, you have, to a degree, even if you're investing a lot of cash, which means you can cash flow less per door, because you're still going to make cash flow, you're still going to need to have, the property needs to maintain itself, in other words. And so these people, normally, they're okay if they break even, because they're waiting for appreciation. They're just sitting on their money, which is totally fine and good for them. But the majority of investors don't really have a choice of where to invest, because there are only a handful of areas in St. Louis that actually cash flow. These areas are generally in North City and South City. I'm sorry, I don't mean North City, North County. There isn't a lot of investment in North City. So North County and South City. Now, of course, there's more than that. There are things you can find deals in the surrounding areas. So in St. Louis County, but generally speaking, these are the areas where investors are super active. And so again, property selection depends, again, location, all these types of things, but also in terms of, you have to figure out, again, do the financials work, because there's stuff overpriced across the board. I see stuff overpriced in South City all the time, where it makes absolutely no sense. And then we look at cash flow calculations. Again, we want to make sure that the property maintains itself. So each investor will have different criteria for what cash flow means. Some people might think that as long as it doesn't lose money, it's making money. If it makes $50 a month, it makes money. But generally speaking, investors are very clear on the minimum cash flow they will allow for their own portfolio. I know I have my own buy box, and on average, though, and this is true across the United States, on average, cash flow is expected to be about $250 per door, which means that a fourplex has to make $1,000 just to in net cash flow after all expenses, including a mortgage, having paid. Okay. Now, some people have higher minimums, and that really depends on what you're buying. So, in other words, $250 per door on a fourplex, where again you end up with $1,000 in net cash flow per month, it makes much more sense than having $250 on a single family home where not only your risk of vacancy is much higher, and your risk is much higher risk that you end up having to pay for the mortgage that month if you have nobody there, but also because of all the expenses, etc., you might, and because of the risk again, you might decide that your minimum cash flow is going to be $500. Okay, something like that. So cash flow can also depend on what you're looking at, the type of property. Right, then we have, of course, you can look at cap rates. So you probably heard this if you've heard investors talk about what they look at in terms of investments. They will look at cap rates and ROI, and of course, it's a matter of also liquidity, what market we're in, etc. This makes sense. It's the same thing across the board when it comes to investments, not just real estate. But in general, when we talk about multis, these are the main two, number 2 and number 3, basically financial assessment, rental income, expenses, etc., and your cash flow calculations are really where it's at. Let's move forward here. So key metrics. So now we go a little bit more into what these measurements mean. And this is not supposed to be a math lesson. So I'm just telling you so that you know when you hear people talk about this, what they're referring to. You will notice that a lot of these metrics are actually similar, because what we're looking always at is this property making money or not? And then we might compare what that bit of making money is, whatever that profit looks like, to another measurement like how much cash I've invested or what is expected for the market, that kind of thing. But it always starts from, how much money is the property making? And I want to point that out because, again, as I mentioned earlier, cash flow is king. So in this case, for example, if we look at the most common ways that investors will evaluate properties, we're looking at the cap rate, which, as you see here, is net operating income over purchase price, and everything is always expressed in terms of percentages. That's why it's multiplied by 100. But the net operating income always is basically what you're left with after all expenses have been paid. Now, not taxes, obviously, because they're very subjective, but it's basically a measurement that can be transferred to not only from the seller, but to the buyer. That's why we look at things that are not subjective, but they're objectively how much is this property cash flowing and what am I pricing it at? So a lot of people look at cap rate. The one thing that I don't love about cap rates, specifically, I don't use cap rates when I evaluate properties. And the reason is that it depends on the market and it depends on the location. So for example, because the top line is NOI, which is net operating income, that depends. Again, if I am in a better location, my income is going to be lower, just because, again, I'm willing to pay more for a property, and therefore the income, even if rents are higher than in a certain area that's actually cash flowing, because my purchase price is that much higher, I might not cash flow as much. And therefore, what ends up happening is that these cap rates are really based on the market, on the location, etc. So it's not a measure that I can use across the board. So say I'm looking at 100 properties to buy, it's going to vary everywhere, right? Depending on the area I'm in, I need to adjust for what the cap rate is there. So you need to actually research what the cap rate, acceptable cap rate is in that area, and then you know if it makes sense or not. So it's a little bit too subjective. I work, as Michael mentioned, I'm a real estate coach as well, and a coach all over the United States, nationwide, and also people that are invest from out of the country. And because of that, we tend to use, or we prefer using, kind of absolute measures as opposed to things that vary by location. And even in St. Louis, we don't even have to go that wide. Even in St. Louis, you have areas where you're going to have to, if you apply this, you're going to have to know what the cap rate is. So I prefer to use the following two, the next two measurements. One is on cash on cash return. Very simply, that means if I buy a property, how much cash am I putting in? And how does that compare to what I'm getting out on an annual basis? So in this case, if I have, again, pre-tax cash flow on a yearly basis, this is how we use this particular measure, this particular metric. If on an annual basis I'm making, I don't know, say that I'm making $1,000 a month on this property, so $12,000 a year, and I've used, to say, an FHA loan where this is where it makes sense to put as little cash into these properties as possible. So I put in, I don't know, 3.5% or something. So say $15,000, and I have then had to do, I don't know, $5,000 of repairs. That's $20,000 for my upfront cash investment. And at that point, I'm going to do $12,000, which is my annual cash flow over the $20,000 in our example, and that gives me times 100. Obviously, that gives me the cash on cash return. I will tell you, and again, I don't want to throw too much at you today, but in this short presentation. But one thing I look at, which is super important when it comes to buying properties, is, and that also affects how much cash flow I will be looking for a property. And when I say obviously this is how, again, a lot of investors do it, is that I will look at how many months of cash flow do I need to put away in order to make one mortgage payment. And so, for example, a property that I'm paying, I don't know, $1,500 in mortgage, I would expect to make about $500 in net cash flow every month, because I know that after 3 months, I can put away one mortgage payment. So that way, every 3 months, I am safe, because even if I have vacancy, I don't have to dip into my pockets to look at that. And that is a twist on this cash on cash return that I'm referring to. But I wanted to give you this example so you see how people think about this type of investment. This is particularly relevant today because of how high the interest rates are. All right. So of course, then we get to the cash flow metric, which again, it's where it's at when it comes to rentals. And very simply, we're looking at net cash flow, which means that we back out of the rental rate, whatever rent we're being paid, or estimated rent, because sometimes the property is vacant, and whatever we would be left with, and that is our cash flow after you pay all expenses, obviously, except for taxes. And the reason I say it doesn't have to be necessarily the rent that it's making right now is because there are sites, even Zillow, but I use Rentometer myself, which I think is fantastic, that tell you, they do comps basically for rents. And they tell you basically how much a property would make. Now, generally speaking, I buy multifamilies. So normally one of the units or more of the units are rented. And so you don't have to estimate. If you do have to estimate, so there is a difference. So one thing I want to say now, because I don't want to forget, this is super important. There is a difference between listing a property that already has tenants in place and a property that's vacant, even though the properties might be completely equal. I've seen agents tell sellers that the property needed to be vacant, like we do for residential. And that's actually the opposite of what needs to happen. Investors will account for the additional lost cash flow, if you want to put it that way. So in other words, if I find a fourplex and only 2 of the units are full, I will account for that, and I will require a discount, because I don't know how quickly. Well, there's 2 reasons. One, I don't know how quickly I can rent that out. I might miss a month, 2 months of rent, and that costs money. Okay, because now I cannot cover my expenses. The second issue with that is that because the units are empty, I might even have to do repairs that I wouldn't have to do if the units were occupied. Because if the unit is occupied, you don't have to go in with extra cash and do maintenance right away or rehab right away. Excuse me. And so when a property is vacant or has any vacant units, that's a concern not a concern as in it's not a stopping point, but it's certainly something that you need to account for as a buyer. Okay, so that's something to look at. One of the best people I've seen, one of the agents that done a great job listing multifamilies, is this man who, I loved it when I spoke with him, and he told me, yeah, because this is how it works. I'm like, love it. And what he was doing is he basically, I don't know if you guys know, that Airbnb has had to change a lot of things. Airbnb is changing. The world of short-term and mid-term rentals is changing, mostly short-term rentals. And again, sites like Airbnb, Vrbo, et cetera, because there's been a lot of pushback from the city. From the cities in general, but also from St. Louis City. In St. Louis City, what's happening is that they passed a law last year where you have to, if you have more than 4, you cannot have basically more than 4 Airbnbs to your name under one license. What that has done, there has been a flood of Airbnb properties on the market, especially multifamilies, because of course it makes more sense in terms of those that you would shut that so you have less doors to your name. What happens is that a lot of these people, because of the income they've been making from short-term, which of course short-term rentals make more income on a monthly basis than long-term rentals, a lot of these people have dumped these properties or are trying to dump these properties completely overpriced because they are evaluating things based on Airbnb income. Airbnb income is not rental income, is hospitality income. Airbnb is a business. It's not real estate. It's not a real estate investment. Therefore, normal, normal, I want to say like the majority of investors, when they buy and hold properties, when they buy rentals, they look at long-term income. That's the only way to evaluate a property. So what this gentleman did, this agent, what he did is he basically stopped. He told the seller to stop his Airbnb business, and he put in long-term tenants. And then he went and priced the property based on the criteria that I'm going to show you for how to price based on, again, cash flow, etc. So he did an excellent job, and he got like 3 offers above listing price. And this was not that long ago, so it's not when everybody was submitting offers above listing price. And he got it sold really well, very quickly. And the guy made a lot of money as well, because I know what he had bought it at. Everything worked out because this agent knew what he was doing. I was very impressed with him that he put long-term tenants in there before selling it. This doesn't happen. Like, this was 1 out of 100 times. I have seen a ton of Airbnb, ex-Airbnb rentals where the people are still running them as they have the property on the market for months and months and months. And it's like a person chasing their tail. It just doesn't work. So, all right, so let's move forward here. So I did want to make a point about that, though, because you will run into people, if you're dealing with multifamilies at all, that were using it as Airbnb, and they'll expect you to price it accordingly. And that's not how buyers buy. All right. So in terms of how we calculate cash flow, just very quickly.
Hey, Maria, can I interrupt you real quick? We did a question come in.
Yeah.
It said, do you prefer purchasing multifamilies over single family homes for rental, and why? If so.
So that's a great question. So first of all, this is a preference. There are many, many big investors that buy single families. There is value to single families, as you guys well know. However, when I had to decide, I used to own single families, and then I went through life and I had to let go of them. And now, of course, I'm rebuilding, and I'm trying to get some passive income going. And I want a certain size portfolio. Because of that, I look at multifamilies because it's that much faster to get to a sustainable number of units. What does that mean? In the past, we used to say that 10 units, just use a round number, 10 rental units will set you up and you'll be done, right? Now, if you want to buy more, that's fine, but you would need a 10 unit portfolio for the portfolio to be self-sustaining. What does self-sustaining means? Is that if I have some stuff that's being rehabbed, I have some people moving out, and I need to basically dip into some cash to make the fixes. Or if I have vacancy, the portfolio itself will feed that. I don't have to have a day job in order to feed the portfolio. I don't have to maintain the portfolio anymore. What has happened over time with everything going up, insurance, taxes, mortgage rates, etc. And now we're saying that really you need about 16. Some people still say 14. I think 16 is really the number where it's at right now, where at 16 now your portfolio becomes self-sustaining. Meaning you have enough revenue coming in where, again, you don't need to go into your pockets. You don't even have to have a day job if you don't want to. And so because of that, obviously I'm after that number, and therefore multifamilies make more sense. Now, most investors, professional investors, prefer multifamilies. The reason for that is not only because of what I said, it is faster, but also because, especially right now where it's so hard because everything is priced higher than it used to be, stuff in St. Louis has gone up like 100% in the last 3 years. Stuff that used to be I was able to buy for a family, for example, in South St. Louis for, I don't know, 150, 200,000. That kind of stuff now goes for even 500,000. So because of that, it wouldn't cash flow. A single family home that has gone through some kind of increase in value like this would not cash flow. it's very hard to find cash flow. And it's easier, therefore, to find it on multifamilies. In fact, fourplexes cash flow better than triplexes and do better than duplexes. Duplexes don't cash flow either these days for the same reason that I mentioned. Basically, you get to spread your fixed cost over a greater number of units. So even though each unit might actually make a little bit less money, for example, a duplex might have a 3,000 square foot duplex might be 1,500 square feet per floor, and at that point per unit. And at that point, of course, it's probably going to it will rent for more than something that say it's 900 square feet, which is normally the size of what you find in fourplexes. So you might make a little less. Say for the fourplex, you make $1,000 per unit, but by the time all is said and done, you have $4,000 in revenue. Whereas with the duplex, you might only have, say, $2,700 in revenue. Okay, so because of that, anytime you get the chance to increase your top line with the expenses staying pretty much the same, of course, a fourplex is going to have higher expenses than a duplex, but not by that much. It's not going to be a proportionate increase, just like for the top line. So every time you do that, of course, you're able to cash flow more. I don't look at anything other than fourplexes for that reason. Does it mean this will always be the case? No, but for where the market is right now, with all the increases in insurance, et cetera, taxes and so on, fourplexes is what most people are looking at. So hopefully that answers the question. And thank you, Michael, for letting me know. That was
definitely that's perfect. Yeah, thank you.
Okay, so in terms of, and one other thing I meant to say, at the end of the day, again, if you're after a big portfolio, it is that much faster just to do, with one transaction. It's also a matter of time, right? And an opportunity. With one transaction, you get to buy four. It's like buying four properties at once, whereas to do 4 doors with single families, you would have to do 4 transactions, might take you a year, whereas you might be able to do 3 multifamilies in 1 year. So there's also, of course, those considerations, but definitely the cash flow consideration is the main one for most people. All right, so in terms of what is cash flow here, so just this is just a little breakdown so you can see. Of course, we look at monthly income, and some properties allow you to have additional income. However, that's normally more true when you really have commercial properties, meaning commercial means 5 units and above. All right, so it doesn't have to be a huge skyscraper or anything. Anything above 4 units is considered commercial. So when it comes to commercial properties, oftentimes you have, for example, laundry rooms, like washer and dryers that are coin operated, et cetera, et cetera. And so that's the extra income they're talking about here. But generally speaking, the multifamilies that we deal with, which are considered residential, normally you don't add anything else, although you could. So in terms of expenses, of course, the ones that are obvious are mortgage payments, property taxes, insurance, that kind of stuff. But what I wanted to bring attention to here is the fact that we have to buyers account for property management fees, because oftentimes you might think that because the seller is managing his own property, and he's making, I don't know, $1,000 a month, the buyer will make $1,000 a month. That's absolutely not true. You always have to account for property management fees. You can do 8 to 10%. Generally, 10% is what I use, but you can negotiate to 8% with a lot of property managers. Even if the buyer is going to manage the property themselves, we still account when we list something. We still account for property management fees, because the fact is we have to prepare for the broad market of investors. We can't say, "Oh, I'm gonna reduce my pool of buyers by saying only people that can manage it themselves." Most people don't do that. In fact, some of the best buyers today, the most active buyers, are people from the coast. I deal with a lot of people from California, even from Georgia, Florida, etc. And for them, obviously, there's only a few cities in the United States where stuff still cash flows. And so a lot of people are interested in St. Louis, and I've been interested for a long time. Even whatever they decide to do, they have to have a property manager. So you gotta, when you list something, you need to apply that ratio as well. And normally, just FYI, property management fees, again, they're going to be 10% of revenue. And then we also have to consider vacancy, the loss that you would have, and how much vacancy you might have. And normally just to give you a working number, we use 5% for that, unless you know that an area is particularly prone to vacancy. But generally speaking, with long-term rents, especially in St. Louis, that's not the case. So we allow for, again, 5% of revenue. So we do want to make sure that that all these measurements, all these expenses are included in our formula. And in terms of utilities, we only account, obviously, for the utilities that are normally paid for by the seller or by the owner. So in this case, would be sewer, water, and trash. Now, I've always and will always pay for sewer myself because it's a lienable item. So I don't want to find any liens on my property. Otherwise, you have to follow up with the tenants, make sure they're paying them. And there are ways to set this up. However, I have seen people also have their tenants pay for these utilities. That's totally fine. At the end of the day, the tenants is going to pay X amount. You want to call some of it rent and some of it utilities. You can do whatever you want. The reason I'm bringing this up in this particular presentation about how to price things is that, generally speaking, buyers will look at this and will include it in their formula. All right. So we can't just chip away at the formula and say, well, no, this cash flows because you can pay the mortgage with it, or mortgage and insurance. It doesn't work that way, because buyers will look at all these items when they do their calculations. All right, let's move forward. Oh, one thing I did want to say. In fact, this is the note at the bottom of this page where it says expenses are calculated for the buyer. This is another mistake that I see made all the time, where agents will ask the seller, how much are you paying for mortgage? How much are you paying for insurance? How much are you paying for whatever? And the seller will say, well, this is what it is, including, for example, a lot of sellers are mom and pops and they manage their own stuff, which is totally fine. Nothing wrong with that. And what happens is that then based on that, oh, it's cash flowing $1,000. And then you price it accordingly, but it isn't, because a lot of not only the seller might have a 3% mortgage, so interest rate, so their mortgage is like half of what you would pay now, what a buyer would have to use. But also insurance. I've seen properties, especially fourplexes, because that's where I'm mostly focused on, where they will say the insurance, they're paying $2,000, $2,500 for insurance. And then when I go and get a quote, it's $35,000 to $4,000, which is pretty much where it's gone to in the last couple of years. So you cannot price something. I mean, you can, but then again, you're going to be stuck with a property for a long time. You cannot price something just thinking of, this is history, this is what it is. You absolutely are supposed to give those figures. But what I'm saying is that the buyer will discount those figures and tell you, well, that's not what I'm going to pay for it, and therefore this is what I need to get the property at. So for you, if you want to focus on how to get the seller to agree to a lower price that makes sense, we're not just here beating up the sellers for no reason. If the person wants to sell, basically you're going to come in and say, by the way, well, the mortgage rate on the price you're saying that you want to list it at, you want to sell it at, is going to be this much per month. This doesn't work. And this happens all the time. I don't even have to go into property taxes and insurance, which also have gone up. Property taxes have gone up 30% a year in certain areas of St. Louis, which is ridiculous because values have not kept up with that as much as they've gone up. What ends up happening is that, again, properties linger because people don't realize the buyer just can't buy it. Now, again, there are buyers that use cash, hard money loans, et cetera, et cetera. But I want to go into that a little bit. There are a lot of buyers that are able to use hard money loans, meaning loans that they get not from banks, but from private lenders. And they're able to then do repairs and then say after a year or two, refinance. But with the market where it is right now, you already from the start need to think about, when I'm refinancing, what am I going to pay? So we go back, it's like a vicious circle, right? We go back to how much is the property renting for? I do want to say one other thing about this rent thing. A lot of what I find right now, and this happens so much, both with mom and pop owners and even professional owners that use property managers that are really not keeping up with the rents. It is paramount that the rent must be a market, which means that, and I see this all the time, because of course, agents, there's only so much we can do, right? When we speak with the seller has tenants that are already living in the property, and then they want you to list this property. However, because they have not kept up with rents, with market rates, the agent is left to say, hey, by the way, I know that the rents are $800 per unit, but really market rates are $1,300 per unit. That is speculation. It doesn't go as far. And of course, you could have done your research. I do the same thing when I look at the potential of a unit, of a property. But when I go and make my offer, I base it off $800. That's what they're renting for right now. I might give it a little more. I might say, okay, I'll assume $1,000, because there are a few things at play here. One is that you cannot kick out people because we have tenant rights in St. Louis, but also in most of the country, where you cannot just, unless it's written in the lease, which I've done before, that, if the property gets sold, then they can change the price on you, right? But basically, generally speaking, you can't. And so if they have a lease for a year, God forbid, 2 years even, just because the market rate is, say, what we said in the example, $1,300, I'm going to be stuck with $800 for months. If you're talking about a 4-family, I might be completely underwater. Okay, if I do that several times, I might be bankrupt by the time I can raise rent. Not only, now what we're assuming is that if I have to bump up somebody's rent from $800 to $1,300, either that's going to take years, because the most I can bump up rent maybe is $100, maybe $200 if it's really under market. But I'm certainly not going to almost double this person's rent in a few months to a year, because otherwise the person's going to move out. And what did I mention earlier about the problem with vacant property? Now all of a sudden I'm missing at least a month of rent. 2, even worse, I might have to spend money to rehab this unit or to fix it before it goes back on the market. So it's not as simple as saying, oh, you can just raise rent. If it were that simple, the current owner would have done it. Now, the problem is that a lot of the current owners, they've had the property for some time. They got it when it was cheaper. They're cash flowing really well. They have no interest in increasing rents. And many of them don't know to increase rents, or they don't really care in general, right? But that's what will kill a rental situation. And buyers can only offer, they have to cash flow. And again, if your rents are not coming in where they need to come in, that's a problem. So as I was saying, if you're going to be listing something, speak with the seller, see if they can at least increase rents by $100 per unit. If they can do that before they list the property, that's an extra $400 for a building, for a 4-plex. It can make a huge difference. In fact, we'll get into a rule in a little bit, a rule of thumb that tells you that it's called the 1% rule of thumb, that basically connects very, very quickly, like back of the napkin calculation, connects rent to how much the property is valued at. And we'll get to that later, so I don't want to spend too much time on it. Let's move.
Maria, Lisa Rozier asked, what is the property management company doing for that 8 to 10% fee?
They save your life. I love management companies if they're good. The problem is, so the key to successfully owning rental property is management. That's where it's at the end of the day. Because you can have the best property with the best tenants, and you have a bad property manager, and they will ruin the property for you. They'll ruin the tenants, they will ruin the property, they'll let it get into disrepair, and they will destroy a perfectly good investment. The opposite is also true. You can have a property that's really bad shape, and the right management company can make that into a jewel. Okay, it's a matter of do they know what they're doing? So what are they doing, to answer your question specifically? One, they collect rents, which sounds easy, but not necessarily, because you're dealing with all kinds of nonsense sometimes. Oh, I can't pay on the 1st, I gotta pay on the 10th. So at that point, if they're good, they're gonna nip this behavior in the bud, and they're gonna make sure that money comes in at the same time. Every time, as per the lease. Because the second that you teach somebody that they don't have to honor the lease that they signed, there's a lot of trouble coming after that. Okay, so they collect rents, and of course they fines or whatever it is for any issue that tenants might cause, but they also need to keep the tenants happy, which means they deal with maintenance, and how they treat the tenants really makes a difference, because you could even have a major issue in a property, because issues happen with houses, as we all know. But if you're a good property manager, then you can keep the tenant happy without costing the seller any money. Or you can get to a situation where basically you burn the tenant moves out, and then the seller again has a vacancy and it still has to deal with the issue that should have been dealt with before. But not only, the issue might get worse and worse as it doesn't get attention, and it doesn't get fixed. So there are several things. Basically, the point, just to make it really basic, the property manager has to preserve the property and potentially make it better, and also has to attract good quality tenants. So, for example, in terms of this, they would have they would do background checks. They would decide, do all the paperwork. There's a lot of paperwork involved. I mean, we're used to it as agents. So they do several things. A great property manager is worth their weight in gold. They really are. There's a reason, for example, right now, having had some really, really bad experiences with property managers before, I actually manage my own properties now. And I realize how much extra money I am making just by doing this deliberately. And so actually my goal is to, which takes time, but it's worth it. My goal is to basically manage as long as I can before giving it to another property manager, because sometimes it's all in the intangibles. So, for example, I take care of my tenants in a way that they're neighbors, they're friends, and because of that, I have people signing up for like 2-3 year leases. That alone, if you can find tenants that will stay with you for 3, 5, 10 years, they will pay off your mortgage. So, and a lot of property managers don't care because it's not their money in the deal. So that's what a property manager does in a nutshell. Was there anything else, Michael? Otherwise, I'll move to the slide.
No, that was it so far. Thank you.
Good. Thank you. All right. So this is what I was referring to earlier when I was talking about just as a very high level screening tool. We use the 1% rule. Now, funnily enough, as I said, everything has gone up. And so it used to be the 2% rule about 15 years ago, meaning that we compare the rent to the price, the rent for 1 month to the price, and we say it should be about 1%, which means now I can look at the deal. Now, let's be clear. It does not mean that if the property is $100,000 and he makes $1,000 per month in rent, that's a good property. I have no idea. I haven't looked at anything. But say this is a good rule of thumb, as in you will attract people's attention if you're more or less at that level. All right. So for a fourplex, for example, say you're making it's $400,000, you would need more or less $4,000 in rent every month for somebody to actually, basically, it will catch somebody's eye. All right. And I can see when people are using this rule, because I literally was looking at a property, was in an area that I'm not interested in, but it was priced so well. And she knew, she didn't mention it because it's not like a rule, like it's a law, it's 1%. But I could see when she did that, I'm like, oh, perfect. That's why it's so important to increase rents before you're going to list something, because then you're able to increase the price and nobody's going to have any issues with it because you're like, well, it's 1%. Now, why do I say this is just a quick and dirty rule? Because in reality, again, if we're looking at a single family home, the percentage of expenses is still going to be higher compared to that same rent. As getting that rent, say I'm making $4,000 in rent on a single family home, it's not the same thing as making $4,000 in rent on 4 units in a multifamily, because the way that it works, again, in terms of risk, you have more tenants, so there's less of a chance you're going to have a month without any rent coming in at all. Of course, the fourth family is going to be worth that much more. So again, this is just a quick and dirty rule. But it gets you started. So say that I'm looking at 30 different properties. I might start with the ones that are closer to the 1% rule. And why does this matter? Because if you're listing and you're trying to close quickly, to actually get this closed within a reasonable amount of time, you do want to look at that. Okay. So I'm not going to, you can read this for yourself. I'm not going to go through it, but basically this is what we're dealing with. And again, it's just a way to filter properties. It's not analysis. You filter the property and then you do the analysis we talked about. All right, so let's talk just very briefly here about cash flow versus appreciation. Again, I've already said a lot, so I'm just doing it very quickly. But basically, cash flow, again, is where it's at the end of the day. However, there are people that don't care about cash flow because they are betting on an area getting better, or they know that in the area they will always have tenants. But here's the thing: at the end of the day, you need to make money. Otherwise, why? If you're thinking, oh, I'm gonna buy it now, and then in 10 years it's gonna be worth double, and then I'll take that. That's fine. That's a different strategy. Completely acceptable, obviously. But again, when we talk about multifamilies, especially, and so on, generally speaking, that's the cash flow formula is really the main thing that people are looking at. However, like you can see here in the note, there are people that are willing to, because they might have more money and they're just parking it somewhere. It's going to give them a higher return if they think something is, there's a pattern of growth in a certain area. It's going to give them more money than might make in the stock market. And not only, but it's a way to diversify if they do have investments in the stock market. So of course, again, we go back to the fact that there are different types of buyers. That's totally fine. Now, in terms of the local market, how things change depending on the area. One of the main things is, of course, we want to see again at those, want to look at those vacancy rates, right? And so we want to look at the demand in the area, which of course depends on, employment situation, all these things. And as I mentioned, there are sites that will give you this information. Even NAR, for example, has a lot of, some of you may already know, they have a lot of statistics on the area. I like to keep an eye on St. Louis and see, how we're doing population-wise and jobs-wise. And it's been, it's a little bit on the negative side. We have been losing people for some time, but it's not major. And again, St. Louis is one of the few areas in the United States that still cash flows, so we do have a lot of investments here. You probably hear about areas in the United States that are hot because a lot of people are moving there. However, the demand, basically pricing, keeps up with those movements. And again, if you're trying to buy and hold, it might not work that well. All right. So that's why places like St. Louis, other great areas in the country, just to give an example, are Cincinnati, Columbus, and Tennessee, for example, was doing well until not too long ago, and so on. And of course, you want to look at if there are trends in gentrification. There are areas, even South St. Louis is not all created equal. You guys know, if you work there at all, that is block by block. Not only there are certain zip codes that investors love. So for example, for myself, I generally look at, just to give you an idea, I look at 63118, 63139, and there are other areas around here. There are people that, for example, I personally like certain areas of 63111, but there are people that are investors that will tell you, no, I don't want to invest there. So it's a matter of preference again. But at the end of the day, you can't really argue with cash flow. If you can prove the cash flow is worth it. Now, of course, to buy in areas that you don't love, you might need much higher cash flow. And this is one thing I do want to say about cash flow. There comes a point where cash flow is too much. I mean, it's too high. When it's that high, it means you're really not paying that much for the property. It means that you're in an area maybe where you don't want to be. So that definitely makes a difference. That's why I'm saying overall, we're looking at $250 per door. Really, that kind of makes sense. If I'm starting to make $600, $700, $800 per door in a multiplex, it means I'm paying nothing for it. The only reason I would pay nothing for it is in an area nobody else wants. So of course you have to also consider that. But again, we are listing for sellers, so you pick up whichever property, but you do need to be aware of what is happening in the area. Okay, just because the rents are high doesn't mean that people are going to pay. We're going to use the 1% rule, for example. All right, managing risk. So again, here, just very quickly, there are different ways that people look at when they look at their portfolio, building their portfolio. They do want to diversify. They might want, again, stuff in different areas. You don't necessarily have to do that when you're just having a few properties. And again, that's not something that I'm just letting you know what people are looking at, but it's not something that you, as the listing agent for the seller, would be concerned with. That's not really anything that the seller can help with, right? But in terms of emergency fund, we go to what I was mentioning earlier. One of the metrics I use is how many months of cash flow does it take to cover one mortgage payment. So this is what we talk about in terms of emergency funds. And you will hear investors talk about capital expenditures. So they will plan for capital expenditures that way. And then, of course, insurance. And you do need to obviously screen your tenants. I do hear still about people that don't screen their tenants. I don't understand. It's so easy these days. You can do that yourself online just by paying $40 for an app. But anyway, as I said, there are people that don't know to do these things because they're doing it on their own. They might have done it for a long time, and maybe it wasn't as simple at the time to do these screenings, but it's highly recommended. All right, in terms of, in general, approaches to investments for these investors, there are people that, again, you will do your buy and hold, which is what we've been talking about. But also you could use one of these rental properties as a fix and flip. A lot of these multiplexes that I see on the market do require extensive repairs. So in this case, they would be vacant, or you would want to basically have them vacant before you can do the work. And that's a completely different story, because then you're talking about either you're going to be refinancing and holding it as a property, as a long-term rental, or you would be selling it to somebody else. The BRRRR method, some of you may have heard about this, basically refers to this process I'm talking about, which is you will buy something, you will fix it, and in order to fix it, you need either a construction loan or hard money loans is what normally we use as investors. And then you would refinance it. You take your cash out because normally the value has gone up. You get a percentage of that value, normally 70 to 80%, depending on the loan you find, and that allows you, if you bought it right, to take out your money. So this is why, for example, as you well know, you've probably seen them around. I mean, this is normal, even with regular houses, you must discount for the repairs needed. However, what a lot of agents miss is that you must more than discount for the repairs needed. These are not retail buyer transactions. So let me give you an example. Say that a property, by the time it's fixed up, the ARV is $400,000. The after repair value is $400,000, but it needs $100,000 in repairs. Because it's an investor buying this, you're not going to be able to price it at $300,000 and somebody's going to buy it. You're going to have to be able to price it at $200,000, $250,000. Okay, whatever it takes to entice the person, because the person not only has to do the repairs, but it also has to be able to maintain this property at a loss, really, because there's no rent coming in until it's done. And then they have to be able to refinance it. And when they refinance, they're going to have to basically, in order to get their money out, to repay the loan and get all that money out, they're going to have to be able to refinance at 70, 80% of ARV. Okay, so I mentioned this because that's very important. And then, of course, there's short-term rentals is another way of looking at things. But again, that's never, and that's the note down at the bottom, we do not evaluate properties based on short-term rentals. Not only Airbnb could go bust any minute. Okay, we don't know what's going to happen with that. There's already a lot of pushback, but you cannot be basing a long-term rental evaluation on something that might or might not exist, or you might or might not want to do, because short-term rental business is hell. And I'm being tongue-in-cheek about it, but the fact is, it's a lot of work. It's definitely a business, and it has nothing to do with rentals. At the end of the day, it is about hospitality, as I said. All right, so now let's talk about us. All right, so what can we do for these sellers so they listen to us? Basically, the main thing here is we come in with data so that we know what we're talking about, and they actually listen when we say to them, no, I cannot list this property 800,000 when it's worth 600, which is literally an example of the property I was telling you about in the beginning that I've been watching. And I'm like, this guy, I mean, I've waited him out forever. And I'm like, I don't know. I'm going to have to wait him out. I don't know how many more months. But basically, we come in as the expert, and this is what we're looking at. Not only, obviously, we are looking at the location of the property. So whether you're on the buyer or seller side, I'm focusing here in this presentation on listing for the seller. But basically, you need to know what area you're dealing with and see what it calls for in terms of all these ratios and metrics we've looked at. But also, you can let the person know, say, hey, this is where the rents are, which agents do. They will look at market rents, but you can't really, rents are sticky. So just because market rent doesn't mean that I buy my property on June 1st and on June 2nd, I can raise the rent. So you need to be able to communicate that to the seller. The seller might think, well, they can just double the rent Well, it's not, it doesn't work that way, right? So you can give financial guidance. Again, the main thing is to let the owner know that how buyers look at these things. And when you break it down, what does it look like from the perspective of the buyer? So again, I might say, well, but I mean, you know, I'm cash flowing $1,000 even with this rent. I'm like, yeah, sure, you bought the property 10 years ago. That's not the case anymore. So we need to be able to break down stuff. I see this mistake all the time. I would say this is actually these two that I just talked about, rents not keeping up with market, and the fact that when they price stuff, they're not actually looking at how much stuff costs for the buyer to buy. These are the two things that really are killing deals these days. And then, of course, negotiations, that you would explain all these things to the seller. And then, of course, if you have great property managers connections, I mean, bring them to me as well. I'm interested because they're so hard to find. All right. So just to basically close out, the point here is again, when we deal with these investors, a lot of the people that hold these properties may not be very savvy, and they might not understand how their buyer pool looks at things. So it's very important for us to show these numbers. Again, you don't have to show all of them. You don't have to know, oh, cap rate, cash flow, but cash flow really is king. And so for you to come in with this information, basically do the analysis that I would do as a buyer, so you can show the seller, say, hey, this is where we need to be. And then you go from there. At least you have a number in mind. I have seen, as I mentioned, a lot of agents just go based off of, well, but houses, which is normally what you hear from sellers, even with just single family homes, don't you? When you say, well, but my neighbor just sold for 500,000, which means I can sell for 500. It doesn't work that way. It's based on rents. And not only, it's based on how many bedrooms do you have? Because while with a house, if you have 3 or 4 bedrooms, the difference in price might not be that much. When it comes to these to rentals, it makes a huge difference. For example, I can tell you right now in South City, single 1-bedroom units rent between $800 and $900 on average, obviously, but 2-bedroom units rent for anywhere from $1,100 to $1,500. Huge difference. So it's not the same as residential again. And of course, even with residential, if you're going from 1 to 2 bedrooms, it's a big difference. But those are off houses, right? We don't normally deal with houses that small. But when it comes to rentals, even something that even with a small amount of space, even if it's small space. So say, for example, a unit is only 900 square feet. Really what matters is the number of bedrooms, as you can imagine. I'm sure you guys know this. But I've seen people, again, not really calculate or consider that to the extent that it should be considered, okay? So I've seen, for example, 1-bedroom units, completely people saying, oh, market rent could be this much, but it's never going to be that much, because we are never going to be able to go to the top of the market unless we do repairs. And if we do repairs, that's a whole new problem, because now how much money is that costing me? So if I'm putting in $5,000 in this unit and I'm only cash flowing, even with the new market rent, I'm only cash flowing an extra $200, how long is it going to take me to make $5,000 back? These are considerations that an investor will keep in mind, as opposed to, say, a residential buyer. That's why I wanted to mention this. All right. Well, that's all for me. Michael, are there any additional questions? Otherwise,
we do. That was very helpful, and we do have a couple. One is are there any red flags to watch out for when evaluating a property?
So, I mean, we could go on. This is a very it's a great question, actually, and there are so many things that really could be wrong. One thing I will look at is the vacancy rate. So again, there are areas, there's a reason why areas of, for example, 63111, people don't like, even though there are areas there that I love. But again, it depends on the block. But and the reason is you can have certain types of tenants, or it could attract certain tenants, because remember, you're also, just like in every other area, you're also dependent on what stuff is going for around you, and also what it looks like. So there are areas where the building might be fantastic and really well kept, but because of what the area has become, or say there's boarded up stuff or whatever, you might still have issues selling it, and you might require a bigger discount, which the seller may or may not be able to do. There are sellers that still have loans, and so they can't go below a certain amount. So that would be a very big red flag to me, really, is the area. And we know this is all about location in general. But again, in St. Louis, in South St. Louis, when it comes to these things, is by block. So I don't want you to just say, okay, well, this zip code is off, and that's that. And then other red flags. If I think about the seller, again, I would, and a lot of people, again, they're not professional managers, so this is not a criticism in any way, but they don't have good records. So they might not have records of what they've done, not done. One thing I have run into, for example, lack of occupancy permits. Okay, so you need to make sure they got them all, because many times, again, you go through the inspection from a city, find out there's work that you need to be doing, and you want to make sure the seller does it before the buyer buys it. But also lack of permits, just like in normal residential deals. People have done, this happens a lot with rental properties. Why? The owners want to save money, right? Because this is not like your primary residence. People want to save money, and many times they do stuff themselves, and you have liability here. Even more liability than usual, because you have tenants living there. And so I would definitely look out for those kinds of things. Those are kind of major things. Now, of course, one thing the buyers take into account is how old the structural elements are, like the roof, the furnace, the water heater, etc. But that doesn't necessarily mean, as long as they are working. This is the difference, I would say, between residential and rental units, is that people don't really care that stuff has to be new. They might just have to capitalize the expenditure, meaning that I know this roof is 15 years old. At some point in the next 5 to 10 years, it will have a hole in it, and therefore I want to save that money on a ongoing basis. Say I put away $50 a month for the next 3 years, and I'll have the money to replace it. So, for example, one of the units that I own, one of the properties I own, has furnaces that are from the 80s, but they used to build them while they work. Of course, I got a discount when I bought it, but they work. And so people will not change those unless they break. And even then, they'll try to maintain them. So you kind of want to know where you're at with those things, because some people might tell you, yeah, but I still need to capitalize for it. So they might want a discount. You do want to let the seller know. I hear this a lot. Well, but they're working. I'm like, sure, but at some point they will not be working. So I need to consider that. And not only in terms of the roof, I don't know what the rules are. This is just a general rule, because I've heard people with different insurance companies that will do different things. Generally speaking, any roof, and you guys know this better than anyone, because this is typical of single family homes just sold, on retail. They have rules about how old the roof can be before it's only cash value. And so obviously that would be an issue, and you might require a discount for that as well if an investor buys.
Perfect. Thank you. And you also mentioned, Maria, an app or something to screen tenants. Do you have something you prefer to use when screening a tenant?
So there are several. My goodness. I use, what is it called? Is the one from, I can never remember. I always call it Keychain. It's not called Keychain. It's called Key. Anyway, it's the app from Furnish Finder. If you go to Furnish Finder, they'll take you to that app. And I love that. It's called Key something. I can't think of what it is. And but a ton of online places where you would find rentals have them. So for example, I know that Zillow has one. And then I think apartments.com does as well. There's so many, and they do such a great job. Keycheck. There you go. Swipe on Keychain. It makes sense. Leo. That's it. Yeah. And I only use it because I do an MTR. I have an MTR, which is a midterm rental, and which I'm testing. I'm testing that concept, and so I use Furnish Finder, and that's why I use that app. It's just convenient. But yeah, there are a lot of these. You just have to do a search. I don't know if any that are better than others. But one, for example, even the credit bureaus have their own app. So for example, I have used before one by one of the credit bureaus. I forgot which one it was. So, and normally it's like we make the tenant pay for them. And so normally it's like $35, $40 per screening.
Cool. And then the tenant takes that on. So that costs. So that's good. Yeah. Really good. And one other question. that came in. What is the biggest lesson you've learned in real estate multifamily investing?
Okay, that properties that are over 100 years old are hell.
Yeah,
So
for sure.
I've been a rehabber for almost 20 years. I've been an investor. That's why I actually became an agent, because I was investing in real estate, and I love being an agent and an investor. But the main thing that I do is I'm an investor, and I have always rehabbed properties in the county that were, I don't know, 50, 60 years old at most. And it was great. And then I took on a fourplex that's 106 years old in St. Louis. It's in the South City. And I'm like, how much harder can this be?
Yeah.
And you open one wall, and all of a sudden you have 3 days of work that you hadn't planned for. So I'd always heard that. But I didn't realize how time consuming the things that have happened, the generations that I've taken or not taken care of a building like that. And so in construction was very different. So that is the biggest thing is definitely to account for these things. Not only something like that, you're really looking over it for the next generation. I sound like a Patek Philippe commercial. And what that means is that you do your best. It's never going to be a new place, but you can make it look. There's so much character in St. Louis. That's why I love St. Louis. And I love the real estate here. And I hope that everybody that buys these properties takes care of them. But I've seen all kinds of nonsense done to these buildings. And sometimes it takes time and patience to recover the buildings. So yeah, that's been my biggest lesson. And honestly, I mean, that's what you're dealing with in South City. It's not like stuff is new most of the time, but I'm at the point where I'm like, okay, I don't know. Maybe we do need to build it from scratch, because these days, especially with modular building, etc., those might be better deals, but this is more competition for the existing stock. So that's why it matters that we price things properly, because and I know you guys know this, I'm preaching to the choir here. Not that anybody wants to be holding on to a listing for a year, but the problem is when you hold on to something for a long time, the market can change on you. We've gone through many iterations of the market just in the last few years. That is like, our heads are spinning. And right now it's a real problem because everybody's almost like in wait mode. I don't know what we're waiting for, and nobody's moving. And that's why it's unfortunate that the few buildings that are actually on the market, they're completely mispriced. There's a reason why they're on the market. The property I was telling you about with that agent that was outstanding, he sold it in no time. In fact, I found it, I think, 3 days after it was listed, and I was already late. Already I got myself into a bidding war, which is not good. So yeah, I mean, property that's priced properly will sell quickly, but otherwise it's a problem.
Yeah, good to know. No, that's awesome. So no, we appreciate you very much being on today. This was very, very helpful. I think everyone got a lot out of it. And then we're going to drop, Leo, if you wouldn't mind dropping Maria's contact info.
I have it actually. I think I have it on the last page. Here you go.
Oh, there you go. Perfect. Awesome. So
yeah.
Give Maria a call if go ahead, Maria. Yeah.
I was going to say, if anybody has any questions, or I hope I haven't confused everybody. I know there's a lot, but the bottom line, again, it's just the fact that, and I know as agents, we like to be prepared when we go take on listings anyway. It's just that some of the things work a little differently than when we're dealing with just straight retail sales. That's why I wanted to share this information, because I think it's going to save us a lot of headaches, and it's going to move, it's going to make everything move faster, which I think it's important. Again, the worst thing I see is when these poor agents are stuck with these listings forever. I'm like, I'm sure, because they get offers, I'm sure. And once the seller keeps saying no, 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 it's just so frustrating. So hopefully this helps.
Definitely. It will. It definitely did. Yeah. I think everyone got a lot out of it. If you have questions, drop them in. It doesn't look like we have any more at the moment. Just thank yous coming in. So, yeah, we thank you very much for taking the time, Maria. That was very, very beneficial, very helpful.
Thank you, Natty.
Yeah. And keep in mind too, Maria she's very, very well skilled in handling short sales as well. We're starting to see short sales rise a little bit. We're starting to see more of them again. So if you have a seller that's running into that issue, they're behind on mortgage payments, give Maria a call. She knows what she's doing there.
Thank you. So, all right. Yeah. Here, everybody. Thank you so much for being here. Bye-bye.
Thank you, Maria. Thanks for being on. We'll talk soon.
Bye.
Bye.